Welcome to Under One Roof MTL, where we are demystifying home ownership 1 week at a time. I am Robin Flynn. We're with you every Sunday from noon to 1, joined, as always, in studio by Martin Spalding of Fred & Martin Mortgages. How's it going, Martin?
I'm doing great. We have got some great news on Wednesday, and I've been waiting all these days to talk about it today.
I know, you're chomping at the bit.
I know.
LJ Realties, I'm sure you're just as excited.
I am so excited. I got to speak to people about it on Wednesday on CJAD. This is fantastic news for people who are looking to get into the market. And like we've been saying for the last little while, people are jumping in. People are seeing the effects of this. So I can't wait to kind of unravel that a little bit during today's show.
Yeah. Before we dive into what exactly it is we're talking about, although you kind of have to be living under a rock to not know what we're talking about at this point, let's make sure we get our trivia question of the weekend, brought to you by Felix and Norton Cookies. If you think you know the answer, 514-790-0800 is the number to text. What is the term for a mortgage where the interest rate changes based on the Bank of Canada's prime rate? You might have a hint in the next couple of segments if you're listening.
I see what you did there.
Just keep listening.
Guys, let's dive in. The big news this week, Bank of Canada's interest rate announcement. They announced on Wednesday they were cutting the key overnight rate by 50 basis points to 3.75%. I mean, we've already surpassed Fred's expectation of 1% for 2024. We're sitting at 1.25 in drops, and it looks like there's no end in sight. I was reading tons of articles yesterday about what economists are predicting for 2025, and I mean, could we be going back into 2% territory, guys?
So here's the thing. Let's unravel that a little bit, because you just mentioned 3.75, which is the overnight lending rate, but that doesn't affect me, you, or anybody realistically. That's just the rate that banks use with each other. So if we peel the onion back a little bit more, our prime rate of Canada today is now 5.95%. And most banks are going to offer you interest rates based on prime. So if you have a line of credit, it might be prime plus one or prime even, maybe even prime with a discount if you're a doctor or a lawyer. And if you have a mortgage, well, your variable rate mortgage is going to depend on prime minus a discount as well. So effectively, 5.95 minus maybe, let's say, a 1% discount, your effective rate today would be 4.95. So that is the new threshold that we're working with. So obviously, to say that, are we going to go into that 2% range? I mean, we could, but we're still far away from that right now. But we are trending in the right direction, and this has been super exciting news for the real estate community.
Martin, how are you feeling? I'm sure when you woke up on Wednesday morning, well, you were probably awake for like 7 hours by the time they announced it, but what was your initial reaction?
Royal.
You know, it's funny because they've been calling it the supersized rate cut. So I had a McDonald's moment. I was going, I'd be happy with 25 basis points. Hey, but Bank of Canada, why don't you supersize that for me and give me 50 basis points? And so we had that conversation last weekend. And you know what? And when I was doing my preparation for this week's show, CIBC is still betting on another 50 basis points come December. So as much as that we're starting to see a lot of activity, because this is so much in the news, there are still people that are holding out. And so I don't advise that you hold out. I advise that if you intend to get into the market, get into the market. Even if there's another 50 basis points coming down the pipe in December. And also we also realize that the government programs of 30-year amortization will kick off December 15th. So those are two variables that a lot of people are looking at. If everybody waits for December 15th or December 11th, which is the other announcement by the Bank of Canada, then it's going to be pandemonium in the market. And we're going to see spring activity through the Christmas holidays. If you're sitting on the sidelines, what we recommend is you get in the market now before it becomes a stampede. And as we mentioned last week, we can go and get you a rate, hold it for you for 90 days, 120 days. So you're still going to be in that window of opportunity. So if you've been sitting on the sidelines, it's time to get off your keister and get into the market and get busy. Call LJ, because I know he's got a lot of listings. Call us so we can pre-qualify you, and let's get busy selling some homes.
Do you think that part of the reason that people are still sitting on the sidelines is because despite the fact that inflation is slowing, prices are still really high? We had high inflation for quite a while, and I was having a conversation with someone who is not super knowledgeable in how the economy and inflation works. And they said, I heard in the news inflation was down, but everything is still expensive. So I think there's this misconception that inflation being down means prices are down, but that's not the case at all. It just means the rate at which prices are increasing is down, right? Things are still really expensive right now.
And things are going to continue to get more expensive because inflation effectively means how much are things going up in price. So now they're only going up 1.6% in the month of September, but that's still upwards. So if it was $10, it'd be $10 and, or is it almost, $11.60. There is still upward pressure on that right now, and that's what we're seeing. We would need negative inflation to start seeing prices go down, and I don't think that's going to happen necessarily. So,
and if you have any of those streaming services, by the way, I got emails from just about every single one this week. Spotify, Disney, Netflix, all of their prices are going up this year. So it doesn't seem like a lot. Yeah, Spotify, all this week, all of them are increasing by $2-3 a month. When you add, if you have all of those streaming services, which I do, that's pretty expensive. That's my interest rate decrease on my mortgage is going to cover the cost of my streaming services. Things cost a lot right now, guys.
But in my humble opinion, I don't see home prices coming down. If anything, it's a demand and supply issue. The fact that there's just not enough supply for the demand because of the growing population, because, I don't know if you saw, the Liberal government announced that they're going to actually lower the amount of people that they're going to give permanent residency to over the next 3 years, because everybody knows there's just not enough homes to go around. So if everybody goes into the market at the same time, say after December 15th, when the new policies come in, what's that going to do? It's demand and supply. It's just going to drive up home prices. I don't see home prices coming back down. I only see them coming back up. So if again, I'm gonna tap on the same nail over and over again. If you're thinking about it, don't wait any longer. Get into the market, because I think that as much as interest rates will continue to go down, and that's what they're projecting into 2025. It's going to mitigate any lower interest rates because home prices are going to continue to increase. So you may as well buy now and benefit from the increased value that's going to be driven by the amount of people who are looking to buy homes.
And I want to add some color commentary based on what we're seeing in the industry right now. I had a meeting with my colleague Nikita this week, and Nikita works a lot of times primarily with first-time buyers. So he's really working in that $400,000 to $600,000 price range. And this week, he submitted 3 offers for different clients. One property received 12 offers. The other property received 8 offers. I think the last one received 6 or 10. It was another very high number, effectively. So he met with me and said, LJ, multiple offers are back. People are excited. People are back into the market. They want to be out there. They want to be buying properties. It's getting very competitive for first-time buyers again. It's starting to smell a little bit like that COVID market that we had a couple years ago. And I said, you know what? At least you're very prepared because you've been doing this now for over 5 years and you've gone through this market and you've walked a ton of buyers through that process. But 100%, we're going to have to be having very tough conversations and really guiding people through this process as the market heats up again, because it's a very different market than it was 6 months ago.
Guys, speaking of hot markets, I read this interesting article this week that said that Toronto and Vancouver are actually the weakest real estate markets in Canada right now. Spoiler alert, apparently the hottest markets right now are Quebec City and Trois-Rivières. Ooh, Trois-Rivières, beautiful Trois-Rivières. LJ, what's your reaction to this? Montreal was kind of middle of the pack at this point, but I mean, what are they even basing this information on? What makes a market hot?
It probably has to do with supply and demand, obviously. And look, I know that Toronto has suffered over the last year effectively because they had a lot of new builds that were coming to market. And with the foreign buyers ban, with the increase in interest rates, with everything that we've been seeing, there weren't enough buyers to pick up those products in particular. So you had a lot of people who even put deposits down originally who decided not to go to the closing table because it just didn't make sense. The pricing wasn't there anymore. And for the first time in a while, you had people who had purchased at prices of, let's say, $700,000, and today's effective value was closer to $650,000 or $600,000. So the downtown condo market was upside down, and we've never really seen that in Toronto, at least for as long as I've been tracking it. Therefore, I suspect Vancouver was probably experiencing something quite similar, and that's what led to people cooling off of Toronto and Vancouver. Obviously, the condo market does play a pretty strong role in the valuations of these cities, given the high density that they are. And then I suspect, obviously, cities like Quebec City and Trois-Rivières that were generally cooler. You have a lot of people, retiring into Quebec City right now, people who want to go just enjoy that quality of life. Trois-Rivières has had a lot of growth recently. They have UQTR. They have a couple of different things that are really booming in that area as well. So I have seen growth in those areas as a whole, and obviously they were a lot less expensive than Montreal, Toronto, Vancouver, etc. So we've seen even investors head out to there. We're meeting with some people who want to go to those markets and start investing there because your price per door on a multiplex is super affordable comparatively.
Now that interest rates have dropped, the markets are getting hot. Get in touch with LJ so you can enter the market before it gets too hot. Call or text him at 514-500-4040. Up next, everything you need to know about interest rates. But first, we're going to check in at the CJD 800 Traffic Center.
Interest rates. What are they and how are they calculated? This is your Mortgage Minute. Interest rates are the cost of borrowing money to buy a home, expressed as an annual percentage of the loan. Rates are influenced by the Bank of Canada's policy rate, lender competition, and the borrower's credit worthiness. There are fixed rates, which remain constant, and variable rates, which fluctuate with market changes. Lenders also consider factors like the mortgage term and amortization period. Interest rates directly affect monthly payments and the total cost of the mortgage, shaping affordability for homeowners.
This is Under One Roof MTL on CJD 800. I'm Robin, that's LJ, that's Martin. Interest rates obviously dominating the news cycle this week with the Bank of Canada announcing that they were cutting interest rates by 50 basis points. However, there is some confusion. When people hear that the overnight lending rate has dropped to 3.75%, they assume that's what their mortgage interest rate should be, but that is not the case at all. So I wanted to take a second to sort of explain to people the differences between different kinds of interest rates and basically everything everybody wants to know about interest rates. So when we talk about the prime rate versus the overnight rate, what are we talking about when we discuss these different kinds of rates, Martin?
I wasn't sure who you're going to throw it to. Okay, so the prime rate is the interest rate set by Canadian banks and financial institutions, which is influenced by the Bank of Canada's overnight rate. It acts as the base for various variable rate loans, including mortgages, HELOCs, and personal loans. The prime rate fluctuates based on economic conditions and decisions by the Bank of Canada regarding the policy interest rate. That's the pure definition of prime rate. The rate you get with a mortgage lender, so when you apply for, say, a variable rate mortgage, your mortgage rate is often set as prime plus or minus a percentage. So we talked about it earlier. Right now, variable rates are at about, so the prime rate is 5.95 minus what I'm seeing is 95 basis points. So the variable rate that we're seeing right now is at about 5%. And that's based on the prime rate. So what the lenders do is they deduct a certain amount from the prime rate, and that's how they establish the variable rate. Fixed rate mortgages is the rate that is not tied to the prime rate. Instead, it's influenced by the broader market conditions, such as the bond yields, and is locked in for the term of your mortgage. So that's when you hear 5-year fixed. That means it's locked in for 5 years. You're going to pay the same amount on a monthly basis over 5 years. And the prime rate is the baseline set by the banks and fluctuates with the economy, whereas the rate you get from the lender depends on your personal credit worthiness and your financial situation. So the bond rate affects the fixed rates, the prime rate affects the variable rates, and what we're seeing currently is not a lot of movement in fixed rates. So I went to check, and the best I saw, where did I write this down? The best I saw right now for 5-year fixed, and this is after, because the bond market already baked in the reduction that we saw on Wednesday. So we haven't seen a lot of movement in fixed rates. So I saw some 4.24, I saw some 4.29, but I am convinced that the bond market is lagging behind this announcement, and in the next 2 to 3 weeks, we'll see fixed rates coming down as well. And so a lot of people say, well, what's your rate today? Well, my rate today is the rate today. But often when you call us, we go and look, we've got access to about 30 lenders, and there's always a lender that's on special. There's always a lender running a promotion. So what you need to do is constantly check in with us, because we've got access to about 30 lenders, and we can get you the best rate of today. It doesn't mean it will be available tomorrow, and it doesn't mean it was available yesterday. So I hope, and I know LJ is going to jump in, but I hope that I kind of painted the picture of what prime and what you get and how variable and how the bond market affects fixed.
Absolutely. That was super clear. LJ, maybe you can answer my next question. So Martin kind of outlined that the prime rate affects things like your mortgage. It can affect your HELOC, personal loans, but there are other kinds of interest on loans, right? You have your car loan, you perhaps have your credit cards. Do these interest rate changes impact those kinds of loans or debt?
So those are typically on fixed rate loans. A lot of businesses will take loans that are on floating rates. So the BDC will typically give you a loan on the BDC floating rate plus a percentage point or two. And that's usually even a little bit more expensive than prime, but it does follow it to a certain extent. I know we spoke about lines of credits, but any kind of larger purchase, anything of that nature will typically be on a floating rate based on prime. But no, car loans and credit cards are typically fixed. I mean, they might choose to change their interest rates once a year. They might decide to go up and down and whatnot, but it isn't tracking the prime rate of Canada or anything of that nature.
But one thing about loans like your credit cards, and this is something, Martin, that you pointed out to me that I wasn't even aware of, was that the interest compounds daily as opposed to annually, right?
It does. And so it makes a significant difference. And so again, if you're carrying a lot of bad debt, sort of credit card debt compounds daily. What does that mean? That means if you owe a certain amount and there's an interest attached to that amount, the interest will multiply. So tomorrow, as opposed to 6 months from now, tomorrow, the amount that you owe will have increased. And the day after, that means it compounds daily. So that means your balance goes up on a daily basis. And if you don't pay it right away, you're actually paying interest on interest on interest on interest. The advantage is let's say you got $40,000 worth of credit card debt, you own a house that's worth $500,000, you've got $250,000 mortgage, you've got some equity in there, you may as well refinance your home, pay off that compounding daily debt, and put it under the umbrella of a mortgage, which is at a much lower rate than a credit card rate, and mortgages only compound once a year. So it's simple math. The advantage of refinancing bad debt and putting it within your mortgage just makes sense. Yes, there are some fees attached to it, but they pale into comparison what you're paying to try to get rid of your credit card debt. And your credit card debt grows daily, whereas your mortgage only compounds once a year. So you'd be crazy to try to pay off credit cards. You may as well bite the bullet, hit the reset button, and use the equity in your house to get rid of that awful credit card debt. And we're talking about credit card debt. There are other debts that compound daily, but credit card is the worst because of the high interest and the compounding daily.
And we're also seeing more of those kinds of debts. People are opting to pay later. Even on Amazon, at checkout, you can do Affirm with monthly payments. You can do groceries at Walmart with monthly payments now. It's crazy.
That's a trap. But
you're
just going to pay more.
But at checkout, it's like, hey, do you want to do this? It's only X number of dollars per month. It's attractive. They're trying to make it attractive.
Because they're betting that in 6 months from now, you won't be able to pay. And bang, you're going to start paying bad interest on it.
Yep.
So coming back to cars, this is the season where they liquidate last year's models. So I expect actually this fall that there's going to be some very aggressive interest and some very aggressive car prices because they're going to want to liquidate their lots and make room for the 2025s. So I think this is also a good opportunity based on interest rates and based on there's a glut of cars on the lots. It's time to buy a car as well, or at least a car.
We're considering a new car, right?
Yeah, I have a 10-year-old Ford Focus that is on its last legs, shall we say. So we are definitely in the market for new cars. So I'm going to take that into consideration.
It's funny. My brother, who's an academic, he's priding himself now to get his car. He's got a Mazda 3. I think it's 15 or 18 years old. It's got over 400,000 kilometers on it, and he wants to get it to 500 before he buys a new car.
It's impressive. Mazda 3 is a great car. I used to drive a Mazda 3. They really last.
Exactly, and it's not costing him anything. So I said, knock yourself out.
Go for it. If you're curious what sort of interest rates you might qualify for, what your options are, you can get in touch with Martin by heading to fredandmartin.com. Still to come, should we be worried about how the new flood zone maps could impact Montreal's real estate market? That's coming up after the news. Welcome back to Under One Roof MTL on CJD 800. I'm Robin Flynn with LJ Aguinaga of LJ Realties and Martin Spalding of Fred and Martin Mortgages. Let's just keep talking interest rates. That's what people are texting in about. That's what people want to know. This is kind of like interest rate 101 this week, if you will. The interest rate itself isn't always the most important part of your mortgage, even though that's what people tend to fixate on. Fred kind of hammers it home all the time that most people will end up breaking their mortgage at some point. So those conditions, those penalties are extremely important. Are there different kinds of penalties and conditions based on whether you have a variable or fixed rate mortgage, LJ?
100%. And this is so important. I believe Fred quotes that 7 out of 10 people will not make it to the end of their term. So 70% is it's such a large number that we really got to know what we're getting ourselves into and how to navigate that. So it's important to note that on a closed variable rate, so a variable rate on a closed term, typically you sign up for 5 years, for example, that's when you're getting the discount from the bank. That's how they lock you in. At that point, you're going to be hit with 3 months of interest as your penalty if you were to break the mortgage before the end of the term. Now, a fixed rate mortgage is a very different calculation that is based on the interest rate differential. And effectively, the bank says, okay, well, we have a contract for the next 4 years. I was supposed to earn X amount of income off of you in interest over that period of time. Today's rates are now, let's say, 2% lower. Well, I need you to basically pay me the spread of that 2% for the amount of time that's left on a calculation to take care of. So I'm not going to sit here and try and calculate it because the banks go through a very complex process. But effectively, that's what they're doing. They're calculating how much money were they supposed to make on your loan, and they're penalizing you for not being able to make that money on you and for breaking the contract early. So there's cases where that could be a small amount, let's say $5,000. Small, I use obviously air quotes when I say that. And I've also seen penalties that are upwards of $30,000. And that obviously can very much change your, well, I'm going to sell or I'm not going to sell, or I'm going to make this change or I'm not going to make this change. I mean, I've seen people kind of tough it out in a separation scenario because the penalty just doesn't make sense yet. We're going to have to wait this one out because financially we just can't afford to pay this penalty right now. So it's very important to understand what are the conditions of your mortgage, what kind of penalties you're looking for. And if you are in the market for a quick change and you really just need kind of a type of bridge loan, if you will, or you're going to do some renovations and you know you're going to be refinancing very shortly, well, there's also an open variable rate. So if you need a mortgage that's only for 6 months or a year, or you need the flexibility because it might be 6 months to 18 months, you can sign a variable rate mortgage that's open. And at that point, you don't have a term, you don't have a commitment. It renews every single month. And that way, you're not having to worry about any sort of penalties. However, they're no longer offering you a discount. So if prime is 5.95, it's probably going to be prime plus 1, prime plus 2. They're actually making a bit more juice because they know that this could be canceled at any point in time. And they need to obviously account for still the manpower, the work that goes into putting together a loan and whatnot. So again, it's a very specific product for somebody in a very specific situation. But if somebody is unsure and doesn't want to take a risk and a gamble between a 6 month, a 1 year, and 8, whatever it might be, you do have that option available to you.
Very cool.
But not all lenders are equal. And that's where, Fred hammers this point week in, week out, that there are a lot of people that if it's too good to be true, it's too good to be true. And if 70% of people are breaking their mortgage before the end, read the fine print, read the conditions, because 5 basis points obviously is often just peanuts compared to the penalty that could be waiting for you if you decide to break your mortgage. And so call Fred because he knows all the ins and outs of all the lenders, but we tend to bring people more towards the monoline lenders. They only do one thing, they do mortgages, and their penalties, should you have to break your mortgage for whatever reason, tend to be a lot lower than if you had signed with one of the big banks.
Now, when you say monoline lender, what does that mean exactly?
Monoline lenders are the virtual lenders. So the First Nationals, the Manulifes, the MCAPs of the world. And unfortunately or fortunately for us, you can only access them through us, through a mortgage broker.
The reason why they're called monoline is because they only offer one product, mortgages.
Mortgages, that's it.
They're not there to give you personal lines of credit. They're not there to give you credit loans for cars and whatnot. It is a mortgage for your property or a line of credit, a home equity line of credit for your property. They only work on basically giving a mortgage for a home or a property. That is it. That is all. And because of that, they can offer more advantages because this is their specialty. When you only focus on one thing, you can really double down on that and be the best at it.
And there are advantages with a monoline lender, I imagine, where they're not constantly trying to upsell you other products, right? If you're with a bank, they're, every time I walk into my bank, they're like, would you like to increase your services with us? Would you like to open this kind of account or this kind of credit card? They're constantly trying to upsell you to get more out of you, right? That's not something you would necessarily have to worry about with a monoline lender, I imagine.
No, I get an email from, I'm with one of the big banks where I do my banking. I don't have my mortgage with a big bank, but I do my banking with a big bank. And I can tell you, I get an email. If it's not daily, it's at least once a week offering me a product. And that, at one point, I find it's fringing on harassment.
It's just because you're
Well, that's just it, But you know what? Actually, one thing that we haven't discussed is the reason that we're so excited that mortgage rates are going down is that they estimate over the next 2 years, 25, 26, a lot of people signed their mortgages during COVID at rock bottom prices, and everybody was feeling that headwind coming over the horizon saying, man, when I renew, it's going to cost me an arm and a leg. The relief that we're seeing from the Bank of Canada, and if CIBC's estimate holds true, we'll be down another 50 basis points in December. If you're renewing in 25 and in 26, yeah, you might pay a little bit more than you're paying, but you're certainly not going to pay if you had renewed a year ago. And so we're thrilled because there are almost 2 million mortgages that are up for renewal in 25 and 26. And at least the Bank of Canada knows that this headwind could have put a lot of families in jeopardy. And I think that also factors into why they're aggressively bringing down mortgage rates.
What would your advice be to somebody who did renew a year ago and they found their monthly payments increased substantially? Do they have any options now that rates are coming down?
Well, there's a perfect example of someone who unfortunately had to renew a year ago that's going to break his mortgage. And he could be confronted with a penalty. And when you break your mortgage and you refinance or you redo a mortgage, there are some fees. There's some fees that are attached to that. You may have to go back to the notary. But it's all math. So you know what? If you want us to break down and crunch the numbers for you, is it worth doing? Knowing that you're going to pay a penalty, knowing that you may have to go back to the notary. So you just got to look at the numbers, and it's all quantitative. It's not emotional. It's black on white, and you base your decision on informed information.
Before we move on to the flood maps, I do have one question for you, LJ. I know you probably spend a lot of time in notaries' offices as a real estate broker. Are notaries still doing stuff virtually? Because when my mortgage last came up for renewal, it was during COVID. So we did everything over Zoom. We didn't have to go into the office. Is that still happening?
So, okay. Last year, the Chamber of Notaries was confronted with a lot of fraud. And because of this, they changed their policies on this. So now the official policy is you are not allowed to do a transaction virtually except for certain exception cases. So there are still exception cases that I am seeing, I don't want to say every day, but on a regular basis. You have clients, for example, I had a couple clients who are Canadian citizens but live abroad who are in the process of purchasing a transaction. So because they don't physically live in Montreal, they qualify for one of the exceptions. I've had a client who was traveling for work, and unfortunately, due to work commitments, he was not able to be in Montreal for this. They were able to qualify for the exception. You are not allowed to go take a vacation during your supposed closing date and then ask for the exception. It does not work that way. But if you're traveling for work, if you have a legitimate reason, if somebody is sick at the hospital, for example, and cannot be displaced, then these are options where you could potentially qualify for the exemption. It'll depend on the notary's decision. They're the ones who are ultimately going to pass this through the chamber and decide how it goes. But overall, we're doing in-person closings with a little asterisk of a couple of exceptions that I'm still seeing today.
Yeah, there's one other thing you can do, actually. You can give power of attorney to somebody as well. But that has to be formally organized so that if We have a client that actually spends their winters in Costa Rica, can be in Montreal for the closing. She has assigned power of attorney to her brother to go and sign on her behalf.
That's what we used to see before the pandemic. That was the normal way of doing it with the powers of attorney, and we've definitely seen those come back into action now.
Before we wrap up this segment, let's make sure we talk about the new flood zone maps, because some people are freaking out because they've never been flooded. They've lived in their homes for like 30 years. All of a sudden, the new flood map zones come out, and they find themselves in a flood zone. Now, this could impact their home insurance rates. This could impact their ability to, rebuild if something were to happen. This can be quite complicated, right? So how is this going to impact the real estate market, LJ? Because when I look at the map, the flood zones actually look quite small when you compare them to the giant size of the island of Montreal. Is this a significant change in your estimation?
So to be honest, I've been pulling it up and I've had trouble kind of deciphering the difference between the new and the old. However, as a general rule, yes, 100%. This is super impactful. I remember when we saw this even a couple of years ago, when we had the big flood in 2017 and then the second flood in 2019, a lot of Pierrefort and Ile-Bizard was very affected by this, and property values 100% went down. And then since then, we've seen obviously insurers not want to give flood insurance for these properties. And then one step further, most recently, we've seen Desjardins come out and say, we are not giving mortgages on these properties. And therefore, if a property can't be mortgaged by a large institution and we can't get insurance for it, well, then you better believe that property value is coming down. And because of these factors, well, obviously now some properties are now upside down effectively. You may have bought it for $400,000, but today nobody wants to give you more than $250,000 for it, because if I can't mortgage it, then obviously my pool of buyers is much smaller because there's not going to be as much demand for it. And if I can't get insurance for it, well, then even more so, less people want to worry about it, above and beyond the fact that most people don't want to have to think about or worry about their entire home getting flooded.
Yeah, there was a gentleman that I was interviewing and all this, and he just finished paying off his mortgage. I think it was like, it took him 35 years, 40 years to pay off his mortgage. And his home was basically his retirement fund. And he actually budgeted, so the day that he sells his home for whatever amount of money, that's what he was going to live on. And boom, his house finds itself on the flood map. So not only is he going to have trouble selling the house, he's going to have trouble insuring the house, but also his house overnight lost value. And he goes, what am I going to do? How am I supposed to retire? I had budgeted so that when I sold it for whatever, $10,000, I was going to live on the $10,000. And overnight now it's only worth $75,000, and I'm going to have trouble selling the house. I find that the flood zone map is a little arbitrary, and because there are a lot of homes on the flood zone map that have never been flooded.
That's crazy.
That's the interesting part. If you've never seen water and you've lived there for 30 years and somebody who has a pencil on a map decides that you're now part of the flood zone, that definitely doesn't seem right to me. We're a little late here. If you want to be part of the action, though, in Q4, make sure you give LJ a call, 514-500-4040. Coming up, LJ has our property of the week. Plus, we'll recap everything that we learned. That's coming up after we check traffic at the CJD 800 Traffic Center. You're listening to Under One Roof MTL on CJD 800. I'm Robin. That's Martin. That's LJ. Our property of the week is one of my favorite segments. Maybe my favorite segment. Oh, I love all our segments equally. Like a parent loves all their kids equally. But LJ, let's hand it off to you. What's our property this week?
Are you looking for the perfect condo in the heart of Montreal? Check out Unit 2304 at 628 Rue Saint-Jacques. This stunning one-bedroom condo offers breathtaking views of Square Victoria, modern amenities, and an unbeatable location near Old Montreal. Priced at just $465,000, it's within walking distance to shops, restaurants, and the metro station. The developer did an excellent job preserving the original charm of the front facade. Don't miss this opportunity. Book your visit today. Call me now. Stop by 49th Parallel for some excellent coffee and a delicious house-made donut. I never lived there without buying a bag of their coffee beans.
Can you say house-made donut again? A house-made donut.
Hey, Montreal's donut scene is heating up. Like, you've got Bernie Bing, Blake Lively, and Ryan Reynolds frequent that establishment whenever they're in Montreal. There's the Homers and NDG.
Homers, yeah.
Very, very cool to see that industry, that area of the food sector opening up. That yeah, exactly. Guys, our trivia question of the week brought to you by Felix and Norton Cookies. If you've been listening to this show since noon, you know the answer. Lots of people texting in at 514-790-0800. One of you is going to win delicious cookies from Felix and Norton. You can check them out at the Blue Haven Shopping Center, 3705 St. John's in DDO. Our question this week: what is the term for a mortgage where the interest rate changes based on the Bank of Canada's prime rate? The answer is a variable rate. If you've been listening to this show, you should have known that. You should have known that. Guys, we learned a lot this week. Let's sort of recap some of that. Yeah, Martin?
Well, Robin, I've got a bit of a scoop, and I'm not sure if Michael Eskenazi, who is the owner of Felix and Norton Cookies, wants me talking about it. But rumor has it there may be a second store opening soon.
What's
wrong? Just a rumor,
Have
though.
any hints to the location?
From my understanding, a little bit closer to the downtown core.
Ooh, that's very exciting.
Yeah.
Very exciting. But for now, go check them out on St. John's Boulevard in DDO, of course. Some of the stuff that we learned this week: Bank of Canada cutting interest rates again, this time sitting at 3.75%. Great news for anyone who has a variable rate, and anyone, really, who has a home, definitely. There's also a lot of different kinds of interest rates, different things to consider with your mortgage, like penalties and conditions. Make sure that you educate yourself. It's not all about the interest rate. And even if you've never been considered part of a flood zone, you should consult the new map to make sure that things haven't changed. You're probably safe if you live in like TMR, because you are nowhere near a body of water. But if you live near the edge of the island, you should probably check out the new map. It's probably some good advice for you. That's pretty much it for us for this week. A reminder, Under One Roof MTL can be heard live every Sunday at noon right here on CJD 800. If you want to learn more about the guys, the show, you can visit our website at underoneroofmtl.com. In the meantime, you can also reach out to LJ, Fred, and Martin individually. LJ, how can people get in touch with you?
You can check out our website at ljrealties.com or on all socials with the handle LJ Aguinaga, that is LJAGUINAGA, or LJ Realties, IES at the end. You can also call or text me at 514-500-4040. I look forward to hearing from you.
Awesome. Martin, where can people get in touch with you and Fred?
Yeah, we'll keep it simple. FredMartin.com, FredMartin.com, FredMartin.com. And if you can't remember LJ's handle, give us a call. We'll get you connected with LJ.
Yeah, because you guys just work down the hall from each other, right? So you guys see each other every single day. So you could walk in, hang out with Fred and Martin, then walk down the hall, check in with LJ. One-stop shop. It's amazing.
That's it. That's it.
If you missed anything, you can listen to the show in its entirety. We are available on iHeartRadio, Spotify, Apple, wherever you get your podcasts. For LJ, Fred, and Martin, I'm Robin. This has been Under One Roof MTL.